Well, I think Mike said it clearly a couple minutes ago, is the anxiety is certainly fading to some extent. Earnings season has been exciting on many names, but what the overhang is on the back end is, where does the Fed move? How much does it move? And I think we have been somewhat in a bottoming process, which takes some time. So we have been picking away at some good value. We're GARP investors, where we've been able to collect, some good assets. But we've also been trimming back on those that have been higher multiple, that we think could probably be more at risk of a very aggressive Fed.
Like what, Chris?
So we have pulled back on some of our software names at this point. The multiples, north of 10 times are probably still more at risk, and we'd like to see them down more in the single digits. We think that that would be a more appropriate place looking forward. But the areas that we still continue to like, that we think are good value and with the secular trends, are semi-cap equipment, communication services, which has been pulled back quite a bit since its outbreak in COVID, where it did very well. It was more corrective last year. And overall small caps have been really in a downward market for the last 11 months. So we're finding a lot of value there as well in the smaller cap companies that have corrected.
Semiconductors, Paul, had a good day, as Melissa noted, up 4% for the group, still down for the year about 6.5%. I know you look at this as a key leading indicator for the market. What does it tell you right now?
Yeah, so it's good to see semis showing some strength. They've underperformed a little bit during this period when growth stocks have come under pressure. That's understandable, but they haven't really collapsed at this point. So it's on a relative basis. So it's not too worrying. Chris was mentioning small caps. We talk about valuations in the market being excessive. In the small cap space, earnings have grown faster. The valuations are more attractive now relative to the end of 2019. So even though we've had a big rally in small caps since the start of 2020, the earnings have grown faster. So you do have more value in that small cap space of companies that do have earnings.
Chris, I'm curious, when you say that you're paring back on some of the higher valuation names like software names, when were you doing that, and at what point do you see some value here? It feels a little bit like maybe enough has been taken out of these names where some people are in fact finding value in the face of the Fed tightening.
Well, we had been trimming for the last couple months in those areas where the high multiple we felt was more at risk. Look, there's some very good high quality companies, and I think if the economy does begin to slow, which is what I think the Fed is trying to do with raising rates on the short end, and we're seeing a yield curve that's flattening. Really, when you look at the 7 and 10 year, it's pretty flat at this point in time. So we do think investors will come back to growth names when they're looking for 20, 25% growth rates, in a slowing economy. I just don't think we're there at that point yet. And we're going to probably see that at some point mid-year.